Bitcoin is up more than 100% this year and is consistently outperforming gold. Has it finally proved itself as a store of value?
We've never had the world's reserve currency, in so much peril. You can't print gold and silver. So I view Bitcoin as digital gold. And frankly, I think it's a better long-term investment than gold. I think it is a superior form of money to gold. It's the most asymmetric bet I've ever seen in 40 plus years of investing. A lot of central banks like to shit on it, so to speak, because it represents a threat.
It's Friday, the 3rd of November, and you're watching Markets with Madison. This week marked 15 years since the white paper behind Bitcoin was released by the pseudonymous Satoshi Nakamoto. The price of Bitcoin is up 10,000%, proving the peer-to-peer electronic cash system is probably here to stay. It's an asset that's typically compared to gold because they both oppose the traditional fiat currency system. So in these high inflation times, which is the better safe haven asset? Investors tend to like Bitcoin and gold for similar reasons. They're both bearer assets, meaning you can physically hold on to them, one in a safe and one on cold storage, like a USB. A lot of investors also hold Bitcoin in wallets on exchanges. They're both considered currency that can't be manipulated by central banks and monetary policy. Unlike printing money, their supply is finite. Gold is a natural resource, and Bitcoin is capped at 21 million tokens. It's currently around 19.5 million. Its supply is halved roughly every 4 years. The next Bitcoin halving is set for 2024. It works like a reward system to keep its inflation in check, where the amount of Bitcoin earned for mining it is cut by half. That's important because it's historically boosted the price. The price of Bitcoin is up more than 100% so far this year and is consistently outperforming the returns on gold. The price is being fueled by hype around institutional interest. BlackRock wants to launch an exchange-traded fund to give more investors easy exposure to it. If approved by the SEC, it would see BlackRock buy and hold Bitcoin. A number of corporates already have it on their balance sheet, the best known being MicroStrategy, which just increased its holding to $5.6 billion US. Tesla and Block also own hundreds of millions of dollars worth. Bitcoin seems to be separating from the rest of cryptocurrency, and there's a camp of analysts that don't even like it being called crypto. Larry Lepard is one of them. He's known for being bullish on both Bitcoin and gold. But which does he think is proving to be the better safe haven asset right now? We go into all of that in this interview. Larry, so good to have you with us. Thanks so much for joining us on this one.
Oh, you're welcome. Good to be with you.
Great to have you here. Now, I know that you like both Bitcoin and gold, but I want to talk to you about the role and future of each of these asset classes in the current environment that the world and the market now finds itself in. Let's start with gold. Why in such an unstable, for lack of a better term, environment where we have massive government debt, wars breaking out, is gold still unable to push through that USD $2,000 barrier?
Yeah, that's a great question. It's getting close. I think it's because right now there's still a piece of the world that thinks that the Federal Reserve, the U.S. Federal Reserve, is going to be able to, beat inflation, and therefore you don't need gold. If you get on Bloomberg today and you look at the 5-year, kind of the consensus 5-year gold price estimates, it's shocking to me that consensus is that gold will be at $1,800 5 years out from now. And I think the odds of that are zero. But also on the Bloomberg charts or consensus estimate, they also think that the 5x5 inflation swap, which is a way of saying in 5 years, for the following 5 years, they think that U.S. inflation will be 2.7%. And I think that's a fantasy as well. I think we are now in an inflationary environment. And so I think there's a big piece of the financial markets that has had a 40-year deflationary run, as we all know, from the 80s into, the peak deflation of March 2020. And they think we're going back there. And so with, it's kind of what I call rear view mirror investing. You tend to you get set in your ways and you think things are a certain way. And when 40 years they are a certain way, well, suddenly here we are 3 years into what I consider to be the new trend, which is an inflationary trend. But I think, a lot of people haven't woken up to it yet. And so, in my opinion, they are waking up to it. And we were getting very close to the breakout in that gold price because, among other things, the gold price shouldn't be where it is today, given what's gone on with interest rates in the United States. As you all know, they've taken the interest rate, the federal funds rate here, from 25 basis points to 525 basis points, which is a big, big move. And generally speaking, when interest rates are going up, gold is going down. Bonds are paying more money, and gold doesn't pay anything in terms of interest. And so you're not interested in gold. So gold should be declining, and yet it's not. And I think the reason that it's not is that it sees around the corner and it recognizes that the US is in a fiscal trap, what I call a kind of a doom loop, wherein we're spending too much money, we're borrowing too much money, interest rates are making the cost of that debt higher, which then makes the deficit bigger, which means we have to sell more bonds. And it's kind of a vicious circle. And I think what gold is sniffing out is the fact that the Fed, the US Federal Reserve, will have to reverse course and start printing money again, because if they don't, the economy is going to collapse, and the financial system is going to collapse. And this all goes to a bigger issue, which is, I think we had an everything bubble that ended in December of 2021. And I think that bubble got blown as a result of 0% interest rates from 2008 to 2016, and then reinstated that again in 2018, 19, and with COVID. And that low cost money, that free money, led to a lot of malinvestment and a very bubble-like environment. And so, that bubble is in the process of bursting. And I think the average investor hasn't figured out what the alternatives are yet. And to my way of seeing it, sound money, gold, silver, Bitcoin are the best alternatives. But I'm one voice, and I would suspect that less than 5 or 10% of the population understands that.
If you think that the macro is kind of misunderstood at the moment, what do you think the macro is going to look like in 5 years' time, and what the price of gold should look like in that 5-year horizon?
In 5 years' time, I think gold will be in US dollars. I'm not going to convert to Aussie dollar or New Zealand dollars. In US dollars, gold should be between $3,000 and $10,000 an ounce, perhaps higher. Bitcoin will be much higher too. Silver will be a couple $100 an ounce. I mean, it's very obvious to me that these assets have been out of favor for a long time. And as I said earlier, people invest in the rearview mirror. I mean, a lot of investors I know have, I've been in the market since 1981. So I've seen a lot of cycles. A lot of people have only been in the market, the younger crowd that manages a lot of the money started in the early 2000s or maybe 2008. And if you started in 2008, you haven't really even seen a bear market, a real bear market. I mean, for stocks, I mean, the consensus view has just been buy the dip. And why do you need gold? Because stocks outperform gold, or that's the thinking, and it's not actually entirely true. But so gold is going to be much, much higher as we go forward, and it's very important, I think, to understand that people trade off of algorithms and people trade off of charts, and we're bumping up against this 2070, 2050 level in the U.S. dollar price of gold. And we actually bumped up close to it back as far back as 2011. We went to $1,900 on gold. So kind of 2050 is kind of a ceiling that we've bounced off of a few times now. And, as I say, there are no triple tops. And so my sense is we're going to go through that ceiling, I think, actually relatively soon. And the reason I say that is I watch what's going on in the bond market. We can address that in a minute. And when we go through that 2100 top, I think we're going to very quickly squirt up to $3,000 an ounce in gold. And because what will happen is there'll be kind of an aha moment, and everyone will say, oh, I get it. This inflation really isn't temporary, and the Fed isn't going to succeed in bringing inflation down. And therefore, we need to have assets which hedge our portfolios against inflation. And as you know, or probably know, gold is incredibly underowned. I mean, maybe not so much in New Zealand and Australia, but in the US, I mean, nobody knows about gold. Nobody cares about gold. I mean, They're probably 75% of the asset managers in the world in the US don't have any gold in their portfolio, and those that do have 1 or 2% as a hedge. And that's going to change, in my opinion, as it becomes more obvious that the inflation that we're experiencing is not a temporary phenomena. It's a serious and long range phenomena.
If you're then looking at a 3,000 to 10,000 USD for gold and you expect more investors to go to it, how ugly then would the situation for equities and bonds have to get? And what's your forecast for that to push more investors towards an asset like gold?
Yeah, sure. It's a great question. Well, for bonds, I think it's going to get really ugly. It's started to get ugly, and I think the trend isn't good. For equities, it's a little bit more mixed. I mean, if you really look at the biggest losers let's kind of draw a comparable. And I was a teenager during the 70s, but let's draw a comparable. The last real period of sustained inflation we had was in the 1970s. And the two best performing asset classes during that period of time were, well, the fixed assets were oil and gold, and real estate, not real estate as much, but oil and gold. And then stocks, it was oil stocks and gold stocks. And so if what we have coming looks like the 70s, and I think that's a very good model to use, what will happen is gold stocks and oil stocks will start to perform very well. And as you know, most investors tend to chase performance. And so, bonds will not perform well at all. Bonds are already down quite a bit off of their peak. And I think they have further to fall because I think interest rates, as you look at the 70s, interest rates went up steadily throughout the 70s. I mean, just constantly. And people who were in bonds just got murdered. And I think that's the same case of what we're looking at now. I think in my opinion, there's no worse investment in the world right now than a bond, a long-term bond. I mean, a short-term one, maybe for a few months paying 5%. If you need to park some money, fine. But stocks are it's a little bit more of a gray area because they are able to reprice, the products they sell in the new inflated currency. So the stocks have a component of their, of what they're about that allows them to endure the inflation. But in general, they don't do particularly well. If you look at the US stock market during the 1970s, the general broad indices like the Dow Jones, they were kind of flat. I mean, they'd have rallies and declines and rallies and declines. I mean, you didn't make much money in stocks. You probably didn't lose a lot either, but it was kind of a sideways chop. And part of the reason for that, and I actually think right now in the US, you could lose a lot of money in stocks, and I'll tell you why. This bubble that we had that ended in December of 2021 was really quite a bubble. And if you look at, the Buffett indicator, which is the measure of the value of the stock market compared to GDP, the bubble that ended in December of 21 was higher than the bubble that occurred in 2000 with .com. It was higher than the 1929 bubble. And in 2022, all we did was come off of it 25 or 30%. And we've actually retraced a big piece of that. So when a bubble bursts, it doesn't just go down 20% and then start up again. It goes back to its base.
Do you think that the Magnificent Seven are kind of just masking this?
Yeah. The
this bubble at the
Magnificent
moment?
Seven are in a lot of trouble. My fund is short a couple of those. And
Which ones?
NVIDIA particularly. I think NVIDIA is a disaster waiting to happen. The people who own those stocks, I think there's going to be a lot of money lost there. This reminds me actually that those 7 stocks remind me very much of like Cisco and all the .com stocks in 2000. It was the same story. You couldn't pay too much for them because they're just bulletproof, fabulous businesses. And they are. That's true. They are good businesses. There's no doubt about that.
But you're still shorting them, even though they are good businesses.
Yeah, well, that's right. It's a valuation issue, right? I mean, a good business can become overvalued. And at some point, it comes back to earth. And that's what I think is in the process of occurring. And the other thing that will happen in the overall stock market is just, earnings are going to go down because labor is going to push the cost to do things up, as we know, in an inflationary environment. And bonds are going to pay higher rates of interest. And so, the PE multiples that we have in the stock market, I mean, the PE multiple is just an inverse of a bond yield. When the PE is 24 or something, the yield is like 4%. And so, the PE multiples are going to contract. So you've got the combination of earnings coming down and PE multiples contracting. I mean, I personally believe, absent a crack up boom, which we can talk about in a minute, absent that, I personally believe the U.S. stock market is going to lose between 50 and 80% of its value in the next 5 years, which is going to be an unmitigated disaster for many, many investors. And what will happen is people will see that they will see that their stocks aren't performing, their bonds aren't performing, and they'll see gold and gold funds and Bitcoin funds and oil companies all doing extremely well, and they'll chase them, and they'll come in this direction because it will become obvious that the inflation is not under control. And that's the key point that I guess I would make, is that I think the big error that most investors and most professionals are making is they're taking the Federal Reserve at their word, and they're believing that Jay Powell has the ability to get inflation under control. And I don't believe he does. Because if he wants to take it to its natural extreme, things are going to break and everything's going to blow up. And a perfect example of that is the way that, his rate increases caused Silicon Valley Bank and First Republic to blow up in March. And of course, they put a Band-Aid on it, and they've got that all back under control. But there are a lot more of those out there, and that's coming. And this period kind of reminds me of 2007, where Bear Stearns failed in March, or, in the summer of, Bear Stearns failed in March of 2008, but the summer of 2007, a couple of the CDS funds blew up, and that was depicted in The Big Short. And, you could just feel the rumblings. And so, we've got another financial accident coming. And when that occurs, the Fed's going to turn the money printing spigot back on, because that's really all they know how to do. And they may hate inflation, they do, but they hate financial collapse even more. And so when the financial collapse starts to come, you just know they're going to print. And when they print, the inflation's going to get worse. And so we're going to have, sadly, we're going to have $3,000 gold and, $100 silver. And I don't know, you guys measure petrol in kilos, in a different measurement than we use, but in gallons. Right now, gasoline in California is about $6 or $7, and where I am, it's about $4. I think those numbers will double in the next few years. So it's a sad state of affairs. The way to fix it would be to have the federal government get responsible and start to figure out ways to balance its budget. But if you look at the political situation here and all that's going on there, you realize that, the odds of that aren't very high, at least not, as things currently stand. And it's kind of stunning to me to watch, Biden recently was saying, well, we're going to send 100 billion here and 50 billion here, there. As Everett Dirksen said back in the 60s, a billion here, a billion there. Pretty soon you're talking real money, and
real money you don't have.
Yeah, that's right. Real money that you do not have, that we are not collecting in taxes. And so, others have said, and I agree, that this is a sovereign debt bubble that's bursting. And, sadly, the United States is starting to look like, a third world country. The model that we're talking about here, this has happened before. It's just never happened with the world's biggest country that has the reserve currency. This has happened in Brazil and Argentina and Venezuela and Hungary and Weimar Germany and Zimbabwe. And there have been plenty of inflations that led to, ultimately hyperinflation or severe, devaluations. But they've never, since the Roman Empire, where they destroyed their currency too, we've never had the world's reserve currency, in so much peril. And, I think what's going to happen is a parallel monetary system is going to develop, and we're going to go back to the tried and true money that, 8 billion people in 5,000 years of history know, that you can't print gold and silver.
Talking about the sad state of the traditional monetary system as you've just explained it, I want to talk about the role of Bitcoin. And if that's everything that you're bearish on, then I want to talk about the ones that you are bullish on, being gold and Bitcoin. If you just consider those, the data shows that Bitcoin has absolutely outperformed gold over the past few years. It's up over 100% year to date. Do you think that Bitcoin has now officially proved itself as safe haven status?
I do. A full safe haven, I'm not sure. Some people still view it as a casino chip and a, momentum play on liquidity. So I'm not sure safe haven. But let me make a number of comments about Bitcoin, because, there are a lot of gold people, and trust me, I'm a gold person. I've always been a gold person. I've been in this trade since the 80s. So long before Bitcoin ever existed, I believed in gold and silver as sound money, and I advocated for them by supporting Ron Paul and other people who wanted to return to the gold standard. So I'm not anti-gold and silver. I love them. Bitcoin came along in 2008, and what these guys invented, and I say these guys because I think Satoshi is actually a group of people who did it and then kind of just let it go out into the market and kept their mouths shut. But what was invented with Bitcoin is something that's rather unique. It's provable digital scarcity. And if prior to Bitcoin, there was no such thing. You could copy anything digital, you could copy it a million times, a photo, a file, a sound, a song, whatever. But Bitcoin's a system of proven digital scarcity, and it's a system of a fixed amount of proven digital scarcity. And money has value because it's scarce. We all agree what is money. It's a consensus thing. And we kind of through history, we iterated down to gold being the soundest money because governments can't print it. There's a limited amount of it. It comes from the Earth's surface. It's tangible. You can see it, touch it, feel it, etc. And all Bitcoin did was it took that concept and it created a digital version of that concept. So I view Bitcoin as digital gold. Gold is analog money. Bitcoin is digital money. Now, there are risks to it. And the biggest risk is that system would fail. And I got involved with it in 2013, but I didn't get involved in a big way. And the reason I didn't is I thought to myself, well, this is based on a computer. And you know what? Computers blow up. And so how can I have money on a computer when computers blow up and it's going to fail, right? But I got to know better how it worked, and I got to talk to more engineers, and I came to understand it better. And it became clear to me, and we've now got 15 years of history, 800,000 blocks, and it hasn't blown up. And so I'm now kind of at the point where it's like, I think the way they designed this and with the redundancy and the 20,000 nodes and, the proof of work and the blockchain, all of it, the having and a lot of integral things that a lot of people who don't know about it don't understand, but if you read about it, you will understand. I think they've actually got a system that's pretty foolproof. And I think the odds of it blowing up are like less than 1% now. So that tells me that, and as you point out, it has been outperforming gold. And I think the reason for that is twofold. I think it's outperforming gold because, well, it's performing well in general because money's being debased. And by the way, even though gold hasn't gotten through 2000, I mean, in 71, gold was $35. And if you compound it from then to now, it's 8% a year. And even as recently as 2015, gold was $1,000 and now it's 1,900. I mean, that's not stunning, growth, but it's not like we're going backwards on gold. It's just not going up as fast as we all would like.
It's at least beating inflation, which is more than most assets right now.
Well, yeah, it is and it's not because they misreport inflation. But you're right. It's protecting you somewhat. Okay, so let's leave it at that. But the reason Bitcoin is crushing gold, in my opinion, and will continue to, and frankly, I think it's a better long-term investment than gold. I think it is a superior form of money to gold. But I don't own all Bitcoin. I don't own all gold. I'm about 50-50 personally. The reason that Bitcoin is crushing gold is that there's an adoption curve going on as well. So if you go and you look at adoption curves, Malcolm Gladwell has done this. You look at how, at some point, 10% of the world had cell phones, and now 90% of the world has cell phones. And I think that's the case with Bitcoin. We're kind of at the 10% adoption point. And I think that, and it's a good idea, and it's working, and it's growing. And I think we're going to go to the 90% adoption point. And if that's true, if I'm right about that assumption, and I say that because I watch the number of addresses growing and I watch the use cases growing. If that's correct, that with a fixed supply of 21 million and 8 billion people, the only way that everyone's going to be able to have some, is at a much higher price. I mean, there's 60 million millionaires in the world. There are 21 million Bitcoin. I mean, every millionaire can't even have one Bitcoin.
So what would you forecast the price at once we hit 90% adoption?
It depends on the time frame. I think with the next run, we'll be at 100 to 200,000. As you know, the last high was in the 60s. I think it's 65, 68, something like that. Corrected back down to 15. I mean, as you know, it's extremely volatile, and that's one of the hard things about it. But, I'm guessing the next run takes us to 150, 200, and then we correct back to maybe 50 or 60. And then the run after that takes us to 600, 700, 800. I mean, I fully expect that each of these coins will someday be worth 1 million and then 2 million, then 4 million. I mean, I think it's just, I think it's going to go up forever, to be honest with you. So
what do you think would tangibly drive runs that large? I mean, how crucial do you think the adoption of a spot price ETF is in that process, or in the grand scheme of things, does it not really
You've
matter?
touched on something that's very important. The spot price ETF is a really important thing, and it's almost a no-brainer. I mean, this is like they've really teed this thing up for us, okay? And I'll tell you why. So in the United States, there's probably $10 trillion of money that's managed by RIAs, registered investment advisors. And that's, a lot of people have their retirement money in these RIA accounts, okay? And right now, if you're a registered investment advisor and your client says, I want to get some Bitcoin, they can't do it. Why can't they do it? Because there's really no way to buy it without an ETF. I mean, as you know, to buy it, you got to have a brokerage account, you got to get a Trezor, you got to cold store it, you got to leave it at Coinbase or someplace. I mean, the RIA won't do any of that. And so you've got this huge amount of money that is asking for it and interested in it, but they don't have the mechanism. And I think it's pretty clear to me that the mechanism is coming. I mean, you've got 7 big companies in the United States, all have applied, all have a lot of political clout, all are talking it up, et cetera, et cetera. And I think it's only a matter of time before the SEC is going to say, okay, we give up. We got to have a Bitcoin ETF. And then when that happens, that $10 trillion of RIA money is going to say, all right, let's put a 2% weighting in this. Well, 2% weighting is a couple $100 billion, and the whole market cap of Bitcoin is only 500, and not the whole, the whole 500 is not for sale, by the way, because there are a lot of us crazies that will never sell at these kind of levels. So,
and I was going to ask you about that, because somebody like Peter Schiff would argue that that would then actually be a tipping point, a trigger for many holders to date to sell. But you're saying that they wouldn't sell.
Oh, no. He doesn't understand who owns this thing. I mean, we all know what it is, and we all know how much higher it's going. Look, at 100,000 or 200,000, there'll be sellers. Hell, I'll sell a little bit of mine at that price. But at the prices that we're at now, no, it's not going to happen. I mean, 75% of the Bitcoin, one of the beautiful things about it is, it's a public ledger, it's a public record. You can see all the coins, you can see all the addresses. And the last time I looked, I think it was about 75% of the coins haven't moved in like the last 2 years. So those coins are in very strong hands, right? I mean, those people, and they ain't selling, not at this price. Now they might let a little bit go if the price is 200 grand a coin, but the point is, the other thing is, I mean, so there are 19 million coins right now. We're iterating slowly to the 21 million. Of the 19, probably, as you probably heard the stories on people, if you lose the keys, you lose the private keys, you lose the coins. Not all 19 million are still available. There are some people who were sloppy in the early days. We think probably 1 or 2 million, maybe more, are just lost forever. The people lost the keys. So maybe there's 17 million coins, and maybe 75% of those are in really strong hands. So, if the total market cap is 500 billion and, you say maybe 10 or 20% of them are lost, so it's really kind of 400 and some odd billion, then you say 75% of the 400 is in really strong hands, so that's 300 billion. So that means there's about $100 billion of available coins that are kind of quote unquote changing hands regularly and available in the marketplace. Well, there's $300 trillion of financial assets in the world. And there's a $10 trillion gold market in the world. The bond market is about 100 trillion. The stock market's about 80 trillion. As I said, these RIAs are about 10 trillion. I mean, so let's say, if even just a small percentage of the RIAs say, buy me some Bitcoin, that's just demand that's going to come in that it's just got to push the price higher. So, I mean, to me, this is really like falling off a log that Bitcoin's going to 100 grand sometime within the next year or two.
But if there's diamond hands all over it, Larry, then who's going to sell for the IRAs to buy in?
Well, they're not all diamond hands. That's why I pointed out there's about 25% that are in people who are speculating and trading it and doing option strategies. I mean, I personally think they're all nuts, because you don't fool around with an asset that's likely to go up 5 to 10x. You just don't. You hold it. But that doesn't mean there aren't people out there who are treating it like a poker chip, and they're trading it. But that's also to answer your question of how can it go up so much so fast. If you look at its price chart, it's a fascinating price chart. It's a weird financial instrument, because there's never been an instrument like this before. I mean, let me just describe something about that a point I want to make there. So the SEC said it's a commodity, and it is a commodity. One Bitcoin is the same as the next Bitcoin, okay? But think about how commodities work. I mean, what are commodities? Gold, silver, corn, wheat, oil. Those are all commodities, right? Every single commodity in the world, if you increase the price a lot, you're going to get more of it. I mean, if oil went to $300 a barrel tomorrow, we'd be drilling for oil in the middle of California. I mean, they'd.
I don't think they'd allow that in California.
Fair enough, but you know what I'm saying. I mean, people find with higher prices, people find ways. I mean, I know, for example, the gold mining business, which I'm involved with, there are a lot of mines that would work beautifully at $3,000 or $4,000 gold. We will mine more gold if the price of gold goes up. Okay, that's the point I'm trying to make. And yet with Bitcoin, the price of Bitcoin could go to $500,000 a coin, and guess what? The issuance schedule is set. So it's a really strange commodity. We've never seen anything like this ever. I mean, this is a new kind of money that people just don't understand what it means, that what digital scarcity legitimately means. And so this thing is going to go absolutely nuts to the upside, in my view. It's the most asymmetric bet I've ever seen in 40 plus years of investing. And I say to my clients, many of whom are gold people and are very skeptical and hate it, and some of whom, I mean, and rightly so. I mean, guys like Sam Bankman-Fried and FTX, I mean, they totally screwed this shit up. I mean, those people pissed me off enormously because they weren't really Bitcoiners. They were crypto, Ponzi scheme grifters. Bitcoin's a different thing. Bitcoin is actually a legitimate technical development.
Okay, on Bitcoin, why is Bitcoin not cryptocurrency?
Yeah, okay, that's really important. So the first thing about it that really is important to understand is it wasn't pre-mined. It wasn't like Satoshi gave himself a bunch of coins. He did have some coins, but he actually mined them himself. It was set up as a computer network and a computer system. It was open source. Everyone can see every single line of code. Everyone can see every address. Everyone can see every coin. Okay, it was fully distributed. The copy of it's a blockchain. So as you know, every 10 minutes, another block of transactions gets filled out and gets added to the existing chain. And you can go back and audit every transaction that's occurred on Bitcoin since 2008 when it was launched. So there've been 800,000 of those blocks since that, more than that, but roughly 800,000 of those blocks since that launching. And the way that they are distributed is the new ones are issued to the miners who actually do the electrical work to keep that blockchain intact. And then the nodes, of which I want to run one in my house and many other people do too, the nodes update every 10 minutes and have a copy of that entire blockchain. So you've got incredible redundancy. You've got incredible distribution. Those 20,000 nodes in the world are spread all over the world. The miners who create the hash rate, who create the new blocks, they're spread all over the world. So nobody really controls it. I mean, the core developers control it, and they can make changes to the underlying code, but those changes will only be accepted if they're beneficial to everyone and they get a majority of the people to run them on their node. And what we've seen is that bad changes just don't get adopted. There are enough people out there to watch how the thing runs that only the good changes get adopted. Now, the other thing that can happen is you can do a hard fork, and that means you can copy the code and start another Bitcoin and call it Bitcoin 2, but nobody will follow you.
I wanted to talk to you about proof points still, about its sort of future as an asset. And one of the earlier arguments was that it needed to be adopted as a currency, like a fiat currency. Do you think that holders of Bitcoin have now sort of done away with that argument and it's just now accepted to be at least a solid free market asset, and institutional adoption and acceptance is more than enough?
I do. I mean, part of what you're alluding to is, no nation states have made it a currency with the exception of El Salvador. And a lot of central banks like to shit on it, so to speak, because it represents a threat to the monopoly that they have on printing money, and they like having that monopoly. Okay. I think that the institutional adoption of it is going to force their hand. And I think ultimately game theory is going to force the hand of all nation states. They're going to realize that if they don't adopt it, they're going to get left behind. But that takes time. People will force the governments to accept it. How does that happen? People lose faith in fiat currencies.
So do you think de-dollarization would effectively force this to occur at some stage?
When a quorum of the people come to realize that the policy of the government is and will always have to be to print more money to dilute the value of the existing money. It's like pouring water in beer, or water in whiskey. They're going to say, screw that shit. I'm going to make my own whiskey. I'm not going to hold that government whiskey. I want to hold gold. I want to hold silver. I want to hold Bitcoin because they can't be diluted. I sincerely believe that gold, silver, and Bitcoin people are going to end up with all the marbles. I think Eric Sprott and Michael Saylor are going to be the two richest men in the world. So that's my view.
Can I make a deal with you, Larry?
Sure.
Can we do this chat every 6 months and we'll keep tracking to that 2030 date and we can track it and see where it goes?
I'm happy to chat as often as you like. And I should say, I say all this with great confidence on the timing. And I should say, I've been wrong a lot.
Thank you so much for your time, Larry. This was fun. I can't wait to do it again soon. Yeah, further to Larry's point, there are obviously people that disagree with him. For example, Peter Schiff. He thinks Bitcoin investors are going to sell if the BlackRock ETF gets approved by the SEC. Peter, if you're watching, take this as your open invitation to come on the show and share your counter-argument. If you invest in Bitcoin or gold, I'd love to hear what you thought of this episode too. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.